Hello, it's Wednesday the 23rd. I'm FX Blue and this is the market brief. So Sunak will be on. He's due to deliver his spring statement to Parliament today. No doubt delivery will be a little different to what he originally prepared, where the increase to national insurance and lifting the cap on energy prices were due to be the big stories. Since then, Russia invaded Ukraine. Sanctions have been imposed all over the show. Oil and gas prices have roofed. And the UK economy is facing repercussions that simply weren't there a little over a month ago. So will Sunak bail out the public again? And even if he tries, will it really make that much difference? The proposed potential 5p cut to fuel duty would barely scratch the surface of the recent petrol price rises, and any minor revisions to the starting level for the new national insurance will be dwarfed by all the increasing costs elsewhere faced by the normal households. As such, the financial markets are pricing in a much higher chance of a recession later this year as the economy adjusts to the new normal. The hope is, of course, that any recession will be kept to the minimum definition, 2 consecutive quarters of negative growth. And the hope is that we'll avoid the stagflation trap, where negative growth is coupled with higher inflation. Much of that is therefore down to the Bank of England and how they balance efforts to control rising inflation with the impact higher interest rates will have on growth. Chances are that their next meeting, which is due on May the 5th, will deliver an unprecedented 4th consecutive rate hike, as the preceding actions haven't really made that much progress, in real terms at least, so far. In the market, sterling has started the week on the front foot. We reached 132.75 against the dollar, and we open around 120.35 against the euro. Over in the US, market opinions on the Fed action are shifting. Where previously the market was a bit critical of the delays and inactivity, the current fear is that they may stamp the foot on the brake a bit too hard when trying to claw back the inflationary curve, as the Fed has shifted from supporting the economy to fighting inflation pretty quickly. The fear is therefore that they should have started sooner and may now be pandering to the market reaction more than planning the future based upon sound economic projections. That said, of course, sound economic projections may be a little difficult for the next few months as the rate hikes begin to bed in, and the additional inflationary pressures from the energy sector hopefully level out a little. Don't forget though, the economy over there, and here for that matter, is still facing the challenges from weaker, fragile supply chains, and that only adds further inflationary pressures to what they're already facing. But with that backdrop, the sentiment is growing that we may see a 50 basis point rate hike at the next Fed meeting, and naturally that is supporting the dollar. The dollar index got close to 99 yesterday, but it is still struggling to break higher despite the global risk appetite still being affected by the war in Ukraine. We pulled back to close around 98.45 yesterday, and euro dollar opens this morning around 110.30. Right, that's it from me. Have a great day. Join me again tomorrow.
If you do not have a clue, then just tweet through and ask FX Blue. Yeah.